So we have had a lot of discussions about, inside the deal and getting to the closing table, owning a home, caring for a home. And we really can't have a conversation like that without talking about how you are actually going to get to the closing table, how you are going to buy a home. So today I am very, very excited to have Charity from Arch Mortgage with us today to talk everything that you need to know about buying a home, and more importantly, as it pertains to young or first-time home buyers, because I know a lot of you following me or tuning in are young and first-time home buyers. So I think this is a really important conversation to have today, and one that I think is really important for this time of year as we're heading into the busy spring and summer season. So Charity, welcome. I'm so happy you're here.
Thanks for having me.
So before we get into all the questions that I have prepared for today, can you just talk a little bit about your experience and, even before, you were even in this industry, what kind of led you to this and your experience and your background?
That's a good question. So I've been in lending for about 6 years or 7 years. Prior to that, I was in title insurance. So I actually went kind of back and forth from processing mortgages back. I had a little title agency of my own for a few years, and then I sold that to a larger company and kind of worked as a manager of that company for a while. So that was my background. And when I decided to do something different, I thought lending was a good segue. I can use, work with the relationships that I had built over those time. I like lending because I feel like I have my group of customers that I'm working with at that time. I feel like it's kind of all in my hands. I'm not delegating everything. And so it pushes my buttons, and I like numbers. I think that I plan with numbers. And so that leads into, I think, some of our questions today is, part of loving a home is figuring out how you can buy it and feel comfortable living there. So you need to know what the payment is going to feel like. You need to know what you're going to need out of pocket, and then you can plan with numbers. So yeah, it's kind of my role in this whole process. So it feels good for me. I like doing that. And
yeah. And I think when you're talking to the word strategy and strategize comes to mind, which I think is something that all of us working in real estate, home buying, like that is really is a lot that goes into a strategy, building that plan of action and a strategy. And I relate to that as well, because I think, when I was growing up, I didn't know that I wanted to, be a real estate agent, but I've always had that more like planning, like type A, very like detail oriented, strategized mindset.
Yeah.
And so I can see how, especially, you wanting to have more control and like be able to help people more with building that plan. Yeah. So I think that makes a lot of sense, and that's
a good way to say it. Like, I think you fall into what you do for a living, but it's because of the things that you are naturally good at or the things that you're interested in. Yeah. And ultimately, like, how are you helping people? What's your role in this world? Yeah. So, whatever it is that you call your title, I think it's really about helping people achieve their goals or using skills that you're kind of good at.
For those who are watching this and don't really understand, can you talk a little bit about specifically Arch Mortgage and, maybe some of the values that you guys really like to focus on, some, community programs, or, what you do? What is Arch Mortgage?
Okay. Yeah. There's different types of mortgage lenders. And so you have a bank, and a bank is using deposits. So they're using checking and savings accounts. They're lending that money, and then they sell a bunch of mortgages together to the secondary market. And that's the big investors are Fannie Mae and Freddie Mac. And then they have their money back so that they can lend it again, write more mortgages. A broker uses other people's money. So we take an application from a client, and then we shop different lenders, and we write it on so we're lending their money, but we are still using Fannie Mae and Freddie Mac if it's a conventional loan. And then they will pool those mortgages together and sell them on the secondary market. So the difference is that we're not using checking and savings account money. We primarily use United Wholesale Mortgage, which is the largest mortgage lender in the country. And because of volume, we have really good terms and pricing and mortgage insurance. Like, people know to shop for interest rates, but they don't really realize that there's also a difference in monthly mortgage insurance premiums. And so we have competitive pricing because of volume. So we get the benefit of that. Also, we only do mortgages. Yeah. I like that. I think that we can be really good at one thing. Yeah. We can move fast. The focus of the entire organization is mortgages. And so they're not concerned about deposits and other things that a bigger bank institution needs to be concerned about. And so you can just be more agile if you need to adjust. We just try really hard to be as efficient as possible. And so we close as fast as we can. Yeah. And that's great. I think, sometimes the seller wants possession, or sometimes we're not moving up the closing date. But if everything is done, we have a clear to close and it's just sitting on the shelf for 2 weeks, that doesn't hurt anybody. It just gets it over with. And then communication is really important. Huge. I think people need to know what's going on. Yes. And especially you as an agent, I think, you have this client, this baby of yours, and you find this thing, you need to hand it off to somebody that is going to get it through the finish line. Yeah. And you need to know what's going on. So I think communication is everything, not just for you, but for your client, and then just being efficient. And, one of the things with lending, just in the process of it, is you gather information, you give it to underwriting. Underwriting looks at it. They want more information. So there is a bit of a back and forth, and you can't avoid it entirely, but you can be as proactive as possible. You do know that they're going to ask for certain things. And, my approach is to try to be like teacher's pet. So when I send it to underwriting, I want the underwriter to like me. I want them to like my files. And I just think that it changes the atmosphere of when they're looking at it and they're like, okay, I have just about everything. I'm going to need this one thing. And versus them being annoyed with me. Do you know what I mean?
So I get that as well. I'm the same way. If I'm missing something, or, you send it to be reviewed and you're like missing something, and then somebody has to go send it back or whatever, that to me is like, oh gosh, I want it to be perfect.
I do too. Yes. And then I think it helps with the process from the buyer's standpoint, because we're not coming back 100 times for things. Hopefully we're only bugging them twice. If things go well, we're only bugging them a couple times. We're gathering every single thing that we can up front that we think that we're going to need. That goes to underwriting. They're always going to ask for something. We're also waiting for some third-party things to be finished, like title work and stuff like that. But hopefully we're not going back and forth and asking for one more thing. Yeah.
Yeah. The two things that you said that jump out to me and that I really want to stress, especially to somebody who is buying a home for the first time, is the communication aspect and the fact that all they do is mortgages. So especially the communication part, and just really building a relationship of trust is so, so important. You are making the biggest financial decision and investment of your life, and you want to feel confident and comfortable. You want to know what's going on with your money, and what can you expect. And I think it's just so important to have a good relationship with somebody that that you can contact whenever about whatever, and not feel bad about it, and not feel, oh, I'm sorry I'm bothering you, but what does this mean?
100%. Yeah. I want people to feel like they're in the driver's seat, and I don't want them to trust me blindly. I want to empower them to have options, to understand their options, and for them to make that choice. And that means that they're going to have questions, and then they're going to walk away, and they're going to think about it, and they're going to have more questions. And so that's 100% how I would want to be treated. Yeah.
Yeah. Empowered. I love that word, and in the driver's seat. And I love when clients do ask me those in-depth questions, because that's what we're here for. That's why we have the skills and the knowledge that we have, so that we can help other people. That's why I, got into this because when I learned so much from the experience that I was like, I know that I can help other people. So moral of the story and, this question here and is really why I believe in working with a local lender is because you can build that relationship, the trust, and they are the experts and you can be great at this one very, very important thing. So I love that. Yeah. I get a lot of questions on the pre-approval aspect. So I just kind of want to start from the top. What is the pre-approval? What does it mean to get pre-approved? If I get pre-approved, does that mean I'm locked in? Does that mean that I have to be buying a home in the next 3 months? What can I expect and how do I get pre-approved?
That's a great question. I think there's a lot of anxiety over it, and it doesn't need to be. There's absolutely no obligation. Mm-hmm. And because we don't do a hard credit pull, there's also no harm. Mm-hmm. So the pre-approval, in my opinion, is helping you close the gap between, you're on the couch, you're shopping Zillow, there's a price range that you kind of find yourself looking at, and then it might show an estimated payment, but it's not accurate. The property taxes might be what the seller is paying in property taxes, but not necessarily what you will pay. So the pre-approval, first of all, is general. So mm-hmm. It's not that you are just getting pre-approved for the one house. It's that you're getting pre-approved for a payment. But then you understand what a realistic payment is for a particular price range and what realistically is required as far as cash out of pocket for that price range. Mm-hmm. So in reality, it helps you take something that's, abstract yes. and makes it more realistic. And mm-hmm. and then, your whole life you're taught to be really careful and cautious with making financial decisions. Mm-hmm. But then we have this market where you have to, immediately spend, $300,000. Mm-hmm. So I think if you did the little bit up front, you get your pre-approval, as you're walking through the house and imagining living there, what the payment's going to feel like, what the cash out of pocket's going to be, and you can guard your heart a little bit as far as falling in love with something that is outside of your price range.
Yes. And I will say that situation happened to me. I was that person. I was on Zillow. I'm looking at some houses. I went online and do a little mortgage calculator. I'm like, oh, okay, this is what I can afford. Let's go see a house. Went and saw a house with, I don't remember Joe Schmo. And he asked if I was pre-approved. I didn't even know what that meant. I was like, no. And he was like, you're going to want to get pre-approved. I talked to a lender. I was quite significantly over the budget. The house that I had looked at was not feasible for me. So, but by doing that, it gave me that perspective of, okay, if this is really what I want, the price range that I want to be in, it's going to take me some time. It's going to take more, saving. It's going to take whatever. And then, 6 months later, I was able to kind of save more, make some changes. And then I was able to be pre-approved for, more. And then, was able to get serious. So yeah, it's really, I like that you said abstract. It's giving you perspective. It's really kind of narrowing things down.
And a path, is what you're saying. So, there's no situation that isn't fixable or whatever. And so sometimes what people just need is a path.
Yeah.
And I would say one mistake that I think people make is they wait until they think that they're ready, mm-hmm. and then they don't want to. It's like they want to get cleaned up before they take a bath, Mm-hmm. So it's like
that's so funny.
It's like, just come and talk to me, mm-hmm. because what happens sometimes is people are like, I have to do these 3 things before I'm ready. Mm-hmm. And if I was part of the process while they were working on those 3 things, there was actually a 4th thing. Mm-hmm. And it's disappointing to tell somebody, yeah, your credit score's there and this, but you do need to take care of this one other thing. And they could have been doing it during the same timeline.
Yeah.
So talk to me early. And even if, like you say, now 6 months later, you realize that you wanted to be in a different spot mm-hmm. than where you were.
Yeah.
And so you were given a footpath. And then in 6 months, you were able to be eligible for something greater. So the pre-approval it helps you know the numbers, and it's kind of your golden ticket to go shopping.
Yes.
And then you get to go and go shopping, and the sellers know you're worth it, or you can do it.
The golden ticket. And if it is a situation where the market is really hot and there's multiple offers, you have that golden ticket. You're ready.
Yeah.
Zillow doesn't know your spending habits. Zillow doesn't know your lifestyle. So again, thinking of, getting that pre-approval and knowing what you can afford, then when you go into that home, you have that mindset of, okay, this is what I can afford. And maybe this is a little bit more than what I'm comfortable with, but maybe I could, change my spending habits or my lifestyle a little bit, or, realistic. I'm not ready to change, my spending habits, and I'm not going to give up these things in my life. So it's important, again, to talk to a real person, a real expert that also knows the local market. Zillow doesn't know all of those things, and especially doesn't know you personally.
And if you're entering your own application, I mean, I the way I like to do it is have a conversation with somebody for 10 or 15 minutes and then send them to the website. So it is pretty electronic. Mm-hmm. They don't have to fill out an application with me necessarily, but it's nice to talk a little bit, because the application is as good as the information that's entered into it. So if you enter that you have a $100,000 salary, then it's going to spit out a number that you're qualified for. But the underwriter there are qualifications for income. So let's talk about self-employment, for example. If somebody's self-employed and they have $300,000 in gross receipts, that's not their qualifying income. The self-employment is kind of a double-edged sword in that you can claim, you may have this great income, but you have the ability to write off all of these deductions and then pay income tax on a lower taxable income. Mm-hmm. So it's good to talk to somebody and know that your pre-approval is valid. And I think that's a big difference between talking to a human or entering your own information is somebody's vetting that, and then your pre-approval is stronger. And that's why it makes a difference in this market. I mean, when you make an offer and it comes from a lender that the listing agent or the sellers recognize, it's going to stand out because they know that they know your reputation. Yeah. They know that you actually looked at the application, that the income has been vetted, and it's less likely that something's going to go wrong, which is what they care about.
Yeah.
So
that's a huge thing. I'm glad that you mentioned is, really like the credibility and the reputation of, okay, I know that they're going to be able to get this done and get it done on time. That's a huge aspect. The other thing that I wanted to circle back on that I really want to drive home is the intimidation factor. And you said that, somebody might think that they have 3 steps before they're ready, but they actually have 4, 5. It's just a conversation. Just start that conversation. And I see it all the time where people say, we want to buy, but not until 6 months from now. And I always encourage them, well, let's just have a conversation of what you are looking for, and let's just get our ducks in a row because there's just so many small factors or things that people might forget about. Maybe they forgot that they had a line of credit open and they didn't even know that it was there. Or I see a lot of times too, people quitting their jobs or deciding, well, if I want to get a house, I need to get a job that's going to pay me more money. So I'm going to quit my job. I'm going to get a new job. Yay, I have a new job in it. And now I have a really great salary. Well, now you don't have a background of employment and income. And that's a big one that I hear a lot from people that is a surprise. And so just start that conversation. Just know all the different factors that go into getting a pre-approval. I think is really important.
I love to be part of the planning stage.
Yeah.
And it's not a bother. It's not, it's just a conversation. And I think it just helps people be set up for success. And they get, you know what I mean? Like if you have 6 months before you're ready to go, that's awesome because you could be just like in your situation with a little bit of knowledge and planning, you can be in a completely different situation in 6 months
Yeah.
because you talked to somebody first.
Yeah.
So,
let's say I'm a little bit of a spender, and I like to use some credit cards, and I pay off a majority of them, but maybe not all the way every month. How can my spending habits, or some things that I'm doing financially, or even things that I might have done a year, 2 years ago, how can that all affect me today now? How does that play into the pre-approval?
it goes right to credit. So if you want to, so there's different things of credit. There's, your credit score, and then there's, the depth of your credit. And so if you're very new to credit, sometimes opening credit cards is a great thing because you're establishing. So credit is basically showing somebody that you can be trusted to borrow money and pay it back. And so if you have a credit card and you use it every month, you have to use it.
Yep.
Then you are demonstrating that you borrow and you pay it back. But overutilization of credit can lower your score. So there's a sweet spot of using credit and using it to serve you versus it hurting you. So if you are somebody who carries credit card balances, there's a sweet spot to where if your balance is less than 10% of the available credit limit, that's where it's a benefit to you. Once your balances exceed that, then it starts to actually lower your score. It just shows that you're overutilizing your credit. So what I would tell somebody, and then there's other people who don't want to use credit. They're like, cash is king. I don't even want credit.
Yep.
Well, unfortunately, we live in a world where we qualify people based on their credit. So you need a score, but you also need to show, like ideally, if somebody has 3 trade lines, like credit cards or installment loans or something, and they have 2 years of history on each of these 3 accounts, that's really solid credit. And then if their credit cards, their usage is below that 10%, then they're going to have a really good score. I'm not saying that somebody has to have 2 years of history on 3 accounts to be eligible, because that's not true. Especially first-time home buyers, there's programs you can have 1, but you do have to have credit. And so I would say, be aware of your spending. Don't keep your balances low. And everything that you have counts. So let's say that you have an income of, I'm going to try to do it so I have easy math to work with. Let's say that you have income of $3,000 a month. And so with a conventional loan, you can borrow up to like $1,500 a month between your house payment and your current liabilities. Well, if you have expensive car loan, you have a lot of minimum payments on your credit cards, you're going to use up that $1,500 with your current liabilities, and you don't have much left for a house payment. So keeping your balances low affords you more in a house payment for your qualification.
Yes.
Like I would say, protect your credit from inquiries. That's another thing. So you go to Kohl's, and if you open up a card, you get 10% off. In my humble opinion, it's never worth it. It just the credit inquiry is going to lower your score by 30 points. If you're trying to get your credit score up, that inquiry just maybe cost you the 10%. In the big picture, it's not worth it. And so I would say be really strategic about what credit you have and what credit cards you have, and then use them. If you're trying to establish credit, open a credit card, use it 1 time a month. So I'll tell people, put it on your calendar to put a tank of gas in your car on the 1st of the month. And the nice thing about that strategy is that if you do it on the 1st of the month, you will use it. You'll know that you used it. So I tried that for myself, and halfway through the month, I couldn't remember if I used the card again. So some months I used it multiple times, and some months I forgot to use it. The tank of gas back in the day was like $30, and it happened to be about 10% of the available limit of the card. Now it's like $60 to fill your car up. But, a tank of gas was good because it's a dollar amount that was that sweet spot of being at 10%. And then certain credit cards, not all, actually give you more credit for the type of purchase.
Yes.
So gas is an essential purchase.
Mm-hmm.
So you're putting a tank of gas in your car. You're doing it one time a month. So you're using the card every single month.
Mm-hmm.
And then I would say, wait until you get the statement and then pay it off immediately. So I had one guy, we were working on his credit, and he just did not want to have any credit cards, but he needed to. So he would purchase something, he'd get right back in his vehicle, and he'd pay it immediate.
Yeah.
So we waited 3 months because we were trying, and we were so excited. We went to pull his credit, and he still had no score.
Yeah.
He's like, what? And
again, it's the game.
It's the game. So we called Discover because what is going on? They said, well, he never had a score on the 19th. So they report to the credit bureaus on the 19th of the month, and he never had a balance on the 19th because he paid it as soon as. Yeah. So he had, so he had to use it, wait until he got the statement from Discover, and then pay it. And then I would say, don't wait and pay it when it's due. Pay it as soon as you get the statement, because that can also spike your score.
Yeah, which for somebody like that, because I know people like this, that's the idea of that sitting there. They're like,
they hate it.
No,
they hate it. And I respect that they hate it.
Yeah,
but
absolutely.
It doesn't change the fact that you have to do it.
Absolutely.
So.
And I'm just now, I'll be transparent. I'm just now learning all these things about, the different types of cards and things, because when I got my very first card, I was in college, and my parents, had me set up with the bank, whatever, and it was a very straightforward card. There was no cash back, no nothing, and the interest rate on it was ridiculous. It was insane. So it just was teaching me pay it off. Do not carry this over. You need to be paying it off every single month. Now, finally, in my now mid-20s, I'm okay, now I think I can really dive into play this game a little bit more. And, things like gas and groceries, how can certain things, if I use a card for those purchases, how can that benefit me? And this is, getting into a lot of financial stuff and credit, but it is so important, and it is another huge intimidating thing when it comes to being an adult and finances and buying a home. It is a lot.
And life is cheaper with good credit. It really is. Homeowners insurance, car insurance, some of those are based on your credit score. You can be eligible for a mortgage with a credit score down to a 580, but you're gonna pay more for that.
Can you talk about numbers wise? What is a good credit range? What kind of number do you ideally want to be at for those who don't know?
I would say, so there's different mortgage programs, and the biggest difference between the various programs is the minimum down payment. That's usually the biggest thing. And especially for a first-time home buyer, the biggest difference is what that minimum down payment is. 700 credit score seems to be the tipping point to where mortgage insurance is more cost-effective if you go with a conventional loan. So as you're talking about different programs, we want to look at what program is the most financially beneficial, but then also what program is the strongest offer when you're making an offer in a competitive situation. So a conventional loan is going to be the strongest offer,
right?
But it can be really costly if your credit score is below 700. Just seems to be that point.
You mentioned something that is a perfect segue into the next thing that I want to talk about, and that is, for many years, and what I grew up with when it came to buying a home, the rule of thumb was you need to put 20% down payment on the house. How has that changed, recently, and how does that benefit young and first-time home buyers?
Yeah, I think there is a perception that to get a conventional loan, you have to have 20% down, and it's not true. Mortgage insurance is this something that you'll hear about if you don't have 20% down payment. No matter what program you go through, if you don't have 20% down, you have to deal with mortgage insurance one way or another. And the different programs kind of address it differently, but it's in there. So it's this necessary evil that you have to pay if you don't have 20% down. It doesn't benefit you as the buyer. It benefits the bank because you're technically a higher risk if you don't have that 20% down. But it drops the more you put down. So if you are going to do a first-time home buyer 3% down payment, you're going to pay the highest monthly mortgage insurance premium because you're putting 3% down. If you put 5% down, it drops. Sometimes it drops quite a bit. It depends. Sometimes there's not that big of a difference between 3 and 5%. It drops again at 10%. At 15%, it's a pretty nominal amount. So, and then at 20%, it drops off entirely. So this mortgage insurance, you're kind of balancing how, is it more important for you to have that cash in your pocket and then pay, maybe $30 a month in mortgage insurance? Sometimes that is the better way to go. And you can get in the house and, that saves you rent. So paying mortgage insurance isn't terrible. And some of the programs for first-time home buyers, there's a couple programs that are income-based. So if your income is within a certain limit, you can qualify for a program like Home Possible or Home Ready. It's a conventional loan, but if you're eligible for this, it caps the mortgage insurance as if you put 10% down. So you could only put 3% down, but pay mortgage insurance as if you put 10% down. Or it also has limits on the pricing adjustments for the interest rate. So you could benefit from the rate and the mortgage insurance with a larger down payment, but you're only putting a small amount down. And to be eligible for that, your income has to be at or below 80% of the area median income. I know I'm just going off, but so if your income is there, then you're eligible for this. And the only qualification is you have to take a homebuyer course. It's something you do online. It takes 1 hour. It costs $100. It's not a big deal. And you'll save that $100 again and again. So it's worth it.
Yeah.
But
okay. So let's say I'm a renter and I have a pretty good salary and I'm consistent and I've got good credit, but I really don't have much saved up for a down payment. I'm paying $2,200 in rent right now. Is there any programs for me that are 0% down? Is that a possibility for me?
Yeah, there are programs that are 0 down. One is Rural Development, USDA. It's 0 down. I guess I should say, when you think of cash out of pocket, it's made up of 2 parts. So one is the down payment that the program requires. So in that case, it's 0 down. And then additionally, you have closing fees that are going to range between $3,000 and $4,000. And you have to set up an escrow account for property taxes and insurance. So when you make your payment, it's a payment that includes taxes and insurance. It's all in. And then from the payment, we set aside the taxes and insurance portion of it. It goes into this escrow account, which is a savings account for those things. At closing, you have to pay the first year of homeowners insurance up front and set aside maybe half a year of property taxes into this escrow account. So there are some upfront costs, even if you have a 0 down program.
Yeah. But
let's say that you're doing the 0 down program. You literally could, not have a down payment. The downside of the USDA program is it is income based. So you have to have an income within the limit for that program. And kind of for the privilege of not having a down payment, there is a lower limit to what your debt to income ratio is, which means that instead of being able, it's going to reduce the purchase price that you'd be eligible for. But certainly it's,
well,
it's good for some people.
And like you said as well, another surprise thing that we have talked about before that people don't realize is you can have a smaller down payment or 0% down, but you are still going to have fees. You're still going to have closing costs and other things that come along with that. Closing costs are a really big one that people don't realize or people forget about.
Yeah.
So I'm glad that you mentioned that. A definition, and what I like to say is there's this clip from The Office that I always think about where he says, explain this to me as if I am like a 5th grader. So simple terms. What is rate buy down and what is refinancing?
Okay. First of all, I'll just put out there, it's really hard to look at interest rates and shop by interest rates because it's hard to know what a lender is charging behind the interest rate. So a really good source to look at interest rates without any lender influence or whatever is Mortgage News Daily. It's an app. You can look at it. You can see what the interest rate is pure without any fees built into it. And you can see the trend of the market. And that way, if you see that the rate today is 6.8% and you see a rate that somebody's offering you of 5%, you can know in the back of your mind that there must be fees associated with that 5% because that's not what the real market is doing. So when I take an application and I see somebody's particular situation, their credit score, the program that we're using, how much they are putting down, the property type, those are all factors that determine the interest rate. I take their application and then I shop it. And so I will get a rate stack is what we call it. And it will have all the interest rates that are available for that borrower. And it might go from 5.5 all the way up to 8.5. And then it incrementally goes up. Well, next to every rate option is the price for that. So for 5.5, you might pay $20,000 in discount points for that rate. You'd never recoup the $20,000. It doesn't make sense to ever do that. And then it might go up to 8.5% where you get a lender credit. So the lender would pay you money maybe to offset your closing fees or whatever. So you can choose to take a higher interest rate and receive a credit. So what I do to start with is you look at what is the interest rate at par? What is the true free interest rate? And that's what Mortgage News Daily should be giving you is like, what is the interest rate without any extra? It's basically watching the market and when it benefits you to start again, to take your mortgage and refinance it into a different mortgage. That's what you're doing. And it might be something to think about. So we're in this market where the homes are appreciating very fast. Home prices keep going up and up. And so maybe initially you're only putting 3% down, but after a year, you might be in a point where you have 5% equity. And so your mortgage, not only would your rate go down, but your mortgage insurance would go down in that case. We are talking about being in a market where throughout this year, the rates are going to go down. So if you were to purchase today and in the fall, the rate, it benefits you because you would save $50 a month or whatever, we would look at refinancing you into the lower rate that's available at that time. And, we try to watch for opportunities for people to refinance. If you've made at least 4 payments, we cover most of the costs of refinancing for you and just trying to help you work at getting out of that mortgage insurance and getting into a lower interest rate.
I'm glad that you said that because I think that's another part of the intimidation factor when it comes to refinancing. So I'm glad that you said that. Kind of moving on to the last few questions that I had. What are some surprising facts or things that, you see most often that people don't know when it comes to buying a home that you feel like you're saying most often or, educating people on the most?
I think I'll say 2 things. One, you mentioned closing costs. I think people don't realize that it's not just the down payment, that there are closing costs associated. And to have a realistic idea of what those are and what your cash out of pocket's going to be real, in reality. And the other thing is property taxes. So in Michigan, there's a law that your taxable value can only increase by 5% per year as long as you don't change the ownership of the property. So if you own the property, your taxes will only increase 5% per year. But once the property is sold, that cap is removed and the property is reassessed based on what you just purchased it for. And that becomes your new tax base that your taxes are going to be. So if you're buying from a little old lady that's owned this farmhouse for 40 years, she might be paying based on a $10,000 taxable value. And you're looking at, what the estimated payment is, and it says the taxes are only $50 a month. That is not your reality because what's going to happen is you're going to own that property that cap that she's been benefiting from is removed, and now your taxable is going to be reassessed, and you're going to experience a huge payment increase for your taxes.
Yep.
So it's just good to have a realistic idea of what, I don't want you to experience payment shock.
Yes. Yes.
You kind of need to know that.
Mm-hmm. So final questions. Someone is looking to buy their first home in the next 6 months. What are your words of advice to them, or what do they need to do today?
I mean, I would say just call me and let's start talking.
That's what I was hoping you'd say. Yeah.
I mean, it sounds, but for real, like, why wait? Why wait? We can start with a conversation. When you're ready, you can fill out an application. We don't do a hard credit pull. Okay, so if you go FHA, I have to do a hard credit pull, but we would start with just a soft check. If I need to do a hard credit pull, I would ask your permission again, a second time to do it. So you're not getting that inquiry. We can really plan with numbers. We can really look at it and talk through it. Since you're not doing a hard inquiry, what I love that we don't do that. I'm preaching it because I think it's so cool that we don't need to do a hard credit pull. But you do a soft inquiry. I can see your score. I can see your liabilities. I can issue a pre-approval. The pre-approval is like a living document, so it continues on. If you're like, hey, right now I only have $10,000. Well, here's your pre-approval today. Next month you've saved more. That improves your situation. Here's your pre-approval today. And it just keeps going. If it takes you 6 months to buy a home, if I had to do a hard credit pull, I'd have to pull your credit every 3 months. And every time I pull your credit, it lowers your score. And it's so discouraging. So I don't have to do that, which I think is great. And then what we do eventually pull the credit. So once you're under contract, then we help you through this opt-out process so you don't get hit by all the solicitation calls, because they're brutal, like hundreds a day.
Oh, yeah. Yep.
Yeah. And then we do a hard credit pull just before closing. So there's no harm. I guess that's my thing is like, there's no harm. There's no reason to wait. Yes. I'm not scary.
Yes.
It's fine.
Does she look scary? No, come on. Yes. I'm really glad that you said that. Just removing that intimidation and, the scary commitment factor.
There's no commitment.
Yes.
There's no money. You're not spending money.
Yes.
There's really no harm.
Yeah. Again, for the people in the back, you're not spending money. You're not spending money. And it's really just a conversation and really leaving things off. It, like you said, it is your golden ticket to go shopping. I really love that. And you guys should do some sort of like Willy Wonka themed event. That should be the next thing, is like get your golden ticket to go home shopping.
That's a good idea.
Now is the time, the season, the market is heating up. And, if you have that dream, you're tired of renting, or, you want a place to call your own, just start the conversation. Just give either one of us a call and let's just start. And if you have any more questions, we really just, I feel, scratched the surface. I know we've been talking for quite a while, but I still feel like there's so many more questions that could come out of this. So if there are things that we missed or things that you still want to learn about, please feel free to comment or send me a message, and perhaps we will be lucky enough to have Charity back.
Anytime.
Thanks so much.
Thank you.